All right, welcome back. Today I'm going to show you, for those of you who have only 10K to your name, I'm going to show you how to buy a slow flip using the cash, infinite banking, and a little bit of some creative financing using a tool called the DSCR loan. Okay, so let's get going. All right, understand that you don't have to use infinite banking. However, for reasons we're going to get into here in a moment, you'll feel compelled to. You really want to take a strong look at it as a alternative to just using your cash. So what I have here in front of you is a bank account earning 1%. Your 10,000 is sitting in that bank account, and for a DSCR loan, we need access to 25% of a $30,000 loan. So a DSCR loan, for those of you who are unfamiliar, is a loan that is granted or given by way of the investment itself. Okay, so it's not like you have to qualify with your income or your credit. For the most part, it's based upon the investment property. And these loans, depending on where you go, they will give you a loan for $30,000, right? And so it's a pretty nifty situation where you can get into some properties where otherwise you wouldn't be able to. Now, I will tell you that ideally you want to get a private money lender. That's like the peak. That's the priority if you can get them. Private money lenders, right? But not all of us are able or feel confident or have the ability to do that. And so therefore, this combination of your own cash and a DSCR loan can really, you can leverage that into many properties. And so this is an example of using that 10,000 and as a down payment portion of your DSCR loan. So let's get into it. This particular scenario, I'm looking at a bank account earning 1%. You're putting 10,000 in for the first year and then 3,000 for the next 5 years, because you'll find out that we're going to be paying off that DSCR loan quickly. Okay, we'll talk about that here in a moment. And then after that, we're going to put in $10,000 into the savings account from year 6 to year 10. Okay, and again, we'll get into why that is in a second. All right, so here is the loan. We cannot forget about taxes, right? Taxes eroding our ability to build up that account. And then the loan is right here in the first year. So notice that with no loans, we have $83,617. But when we take out money, right, that money is no longer there to grow for us over the course of 25 years. And so now we have $76,000 if we take out a loan. Now, everything changes if we put that cash flow back into your bank account, right? But in this case, for reasons we'll get into in a moment, we're not putting that cash flow back into the bank account, okay? All right, so here is the DSCR loan, okay? So the DSCR loan is a 30-year loan. The balance after we factor in our down payment is $22,500, and it's over 30 years, amortized at 8%. 8% is the going rate right now, and so that payment is $165 per month. Man, first of all, if you're seeing this, you're probably thinking, well, finally get to actually take hold of my cash flow, have some cash flow. Well, I'm gonna tell you to time out, slow your roll, okay? Because what we really want to do is not have this debt service here for 30 years. We want to have it for 5 years, and so we're gonna treat it like we're gonna pay it off like it's 60 months instead of 360 months. So to do that, we've got to throw more money at this monthly payment. So I've already done the math. It's $300 extra to pay off that amount in 60 months. So if you look here, we pay that off in just shy of 60 months, okay? So 5 years. So voila, if we throw $300 extra at this loan, we've paid it off in 5 years, no prepayment penalties or anything like that, okay? And we're treating it like it's a private money lender loan. I've already done the math as well. If you want to pay it off sooner, you throw $500 extra at this loan, okay? And you pay it off in 3 years. And so it's kind of cool that you have that level of flexibility. My point here is that you're going to want to pay off this debt service first, as opposed to rolling any cash back into your 1% savings account, okay? All right, so now that we're clear on that, let's look at an alternative method. Instead of using your bank account, let's use a policy, okay? So I've already worked out the numbers here for a 40-year-old, okay? Putting in the same amount of dollars, 10,000, 300, 3,000, 3,000, 3,000, so on and so forth. So in this case, we have instead of 10,000, we have 8,200. We still have enough to take out a loan. So we take that loan out, and in this case, we're just going to pay interest only. The insurance company is charging us 5%, okay? We're just going to pay interest only, which is our right. We don't have to pay anything if we don't want to, but I always teach, hey, at least pay the interest on the loan, so that way the loan doesn't continue to compound year over year as far as adding up interest, okay? So $375 per year is the amount of the interest, and so pay that while you have that loan outstanding, okay? All right, and then in the 6th year, when you've paid off the DSCR loan, you pay that loan off in full, okay? So what I want to show you here is that, again, we had 76,000 if we took a loan from the bank account. But here, over 25 years, we have 170,000, okay? 73,000 compared to 170,000. That's about $100,000 more in growth over a 25-year period, all right? Now, I don't know about you, but I would prefer to have $100,000 more in my own banking system. And here's the reality. You know, I could talk about the taxes that you pay, the double taxation if you were to use money from a bank account and put that money back in, right, to get taxed again. I could talk about the lost opportunity costs. Here, almost $100,000 of money that we don't get to see if we put money in a bank account. But I'll put that aside for right now. What I want to talk about here is something I rarely speak about, and it's the system itself. The system will set you free. The system incentivizes you, right? You are incentivized to put your money back into your own system that you own and control, okay? Think about the bank. When you put money there, they're lending that money out to other people. They're lending your money out to other people, okay? And they also have the audacity to let the IRS know, let Uncle Sam know that, hey, you made profit on this, as little as it is, and you got to pay tax on that, okay? And think about this. What happens if you didn't come home tonight? If you got hit by a bus, is your bank account going to make your family whole? Doubtful. Actually, absolutely not, right? Whereas your own bank will, okay? Again, I don't bring that up very often. The death benefit is normally something we don't talk about very much, but it's part of the package when you have an infinite banking policy, okay? So with that said, I'm going to leave it right there. When you control your income, you control your outcome. If you have any questions about this, feel free to reach out to me. I would love to answer your questions. Okay, thank you.